Hello everyone. So I said in a recent video that one of the keys to long-term investment success is to actually stay the course. So you've got to get through some pretty tough and uncomfortable short-term headwinds at times in order to get to those long-term returns. It's a bit like, imagine seeing your favourite beach bar off in the distance. So the end prize is there, you're pretty certain of that, but to get to it, you need to get over the investment equivalent of Cheddar Gorge. So one of the key things for investors to understand is how long-term returns work. Now this might sound easy and obvious, but actually getting this idea right in your mind can be a lot more challenging than you might first think. But when you understand it, it can be really powerful. So let's kick off with a high-level concept. So as an investor, of course, you're looking to grow the value of your capital. But if we take this one step further, you need the value of your assets to increase at a rate higher than inflation over a sustained period of time. That's really the key to this. Now, you're also going to want a reward for tying up your cash in a given investment, and essentially you want compensation for the fact that you're risking your capital. In most cases, there is no guarantee that you'll get your capital back. So broadly, the traditional way of looking at returns and risk is that the more risk you take, the more return you should get. This is the sort of economics textbook definition, but by the way, it doesn't always work that way, especially over short periods of time. But this high level concept is basically what every investor has to get their head around, has to navigate. Now, how much risk do I want to take in the pursuit of returns? And will I get rewarded for taking that risk is essentially what you're asking. Now, if we look at where things are today, we could say that cash is a supposedly safe investment. So you're unlikely to lose the notional value of your cash if it's in, say, a UK bank, subject to certain limits. But the return that you're going to get is very minimal, and at the moment anyway, is way below inflation. So in real terms, inflation adjusted, are you just losing money safely? That's what you've got to ask yourself. Now, at the other end of the spectrum could be something like shares in the world's developed or emerging countries. And developed country equities have returned you almost 10% a year on an annualized basis if you look at the period between, say, 2006 and 2020, so a decent period of time. But the difference is that whilst the nominal value of your cash has never fallen, the nominal value, important to remember that, the value of your investment in global shares has taken several really quite notable falls in value over that same period of time. So you've had the financial crisis of 2008, you've had the outbreak of COVID-19 in 2020 and lots of other bumps along the way. But in between these two assets, there are a number of other investment options, and they all sit somewhere on this spectrum of return and risk. So this high-level trade-off between security, or perhaps people's perception of it, and returns is fundamentally a part of investing. The logic explained here is really why your investment manager or financial advisor, if you have one, might get a bit squirmish if you tell them that you might want some money out of your, let's say, fairly aggressive portfolio at some point in the next couple of years. What's worrying them is that these long-term returns work, but only if you remain invested. Now, the other point to understand is that returns come in lumps. So whilst we can all make a lovely long-term chart that shows a conveniently sort of upward sloping line, the actual returns tend to come from a small number of really good days in the market. So I remember seeing a note from quite a prominent US wealth manager last year, and it quoted returns from the S&P 500. So they looked at data since 1927. So if you'd invested $100 in 1927 and remained invested there until May 2020, your investment would be worth quite a staggering $16,800. But if you miss the 10 best days of return, so that's 10 days out of about 24,000, your return would have fallen to around $5,500. So this is the power of staying the course and of compounding over time. Now, the final but very important point I'd like to make on this topic is something that I call time arbitrage. So as a species, us as humans, we're very impatient. We don't tend to like to wait for things, and investments are no exception. Now, that's all well and good, but the best returns come from long-term compounding, as we now know. So if patience isn't your strong suit, it's really time to start to get to grips with it. And once you're happy with this idea of being patient, I really firmly believe that you've got an edge over a lot of other investors. Most people in the investment markets are looking to make decisions on where to allocate capital really over the next 12 to 18 months, some even less than that. But if you're looking at, say, the next 12 to 18 years, you've got a vastly different perspective. So, for example, the stock that they might want to sell because, let's say, next year's profits might be a bit below expectations, well, actually, could that be a great opportunity for you as a long-term entry point? Now, the potential downside here is that you have to endure occasionally, from time to time, you may underperform the wider stock market or a benchmark if you have one, and that bothers some people more than others. I'm probably in the latter camp, to be honest. So hopefully the concepts that I've outlined here can really help you in your own investing journey. And as always, please do like, comment and share if you found this helpful. Thank you.